Well, it's earnings season, so let's get straight to our next corporate. And this time around, we have a banking name that's joining in. CSB Bank, well, they're in focus on the back of their Q1 numbers. Overall, it was more or less a steady quarter. Gold loans, that's the one that's driving the growth out there, though the corporate and retail book remains sluggish. Joining us to understand more about the last quarter, as well as the way from here on, we're joined by Mr. Pralay Mondal, the Interim MD and CEO of the bank. Hi, Mr. Mondal. Thanks so much for joining in, sir. Well, give us an outlook in terms of your loan growth from here on, and will gold lead it? Because that's precisely what's happened in the past quarter. Go ahead.
Yeah, thanks, Nigel, for having me on your show. Yes, gold loan did well, as it did well last 2 quarters as well, sequentially. And we grew by more than 26% year on year. To some extent, it is also a base effect because we had, because of the LTV issue, we had a lower base last year at the same time. Having said that, I think gold loan will continue to drive our growth for the next 12 to 15 months. And when we are building most of our other products, especially on the retail payments and all those businesses, also we are planning to enhance our ability on the liability franchise, because if we want to have a higher growth compared to what we had last year, and even compared to what we are having right now, given the interest rate cycle, I think one of the key focus also will be to build up the CASA and the liability franchise. So I think gold will remain the mainstay for another 12 to 15 months, and then other products will also start kicking in, which includes all the retail products, the SME and the wholesale as well.
Mr. Mondal, morning, and thanks for joining in. This is Reema here. Will gold loan look strong even in Q2 because of the base effect? And what happens Q3 and Q4 once the base effect wears out? What can be the growth then?
So I think on a year-on-year basis, we should continue at the same level next quarter as well.
Okay.
Q3 and Q4 sequentially will continue to do well. But as you rightly said, based on the base effect, it may slightly come down. And by that time, some of the other products will start picking up. So overall, I see our asset growth to be even stronger than what it is today by the end of the year.
The number on the loan growth, and if you could break that up for the full year in terms of gold loans and ex of gold loans.
So that's very difficult to give at this point of time, because it depends on, there are so much volatility in the market in terms of, ECB also raised rates by 50 basis points after 11 years. We have to see where the FOMC is going. What is the RBI decision? So there are too many macros which are happening, but I would expect, because we are a small balance sheet, I think we should be able to grow consistently. I think on a year-on-year basis, we should be able to better than what we have done this quarter on the asset side. And of course, to fund that, our liability also has to grow well. So overall, I think we should be able to do better than the overall credit growth that happens in the that is expected in the system for the next 3 quarters. We should be able to better that, yes.
Okay, Mr. Mondal, good morning and thanks for joining us. Can you also take us through what is your expectation on the margin front? We did see it declining a little bit sequentially. It's at around 5.17 right now. Can you tell us what is the expectation on the net interest margin?
Yeah, thanks, Pavitra, for your question. So I said last time also that our margins was an exception last year. Given the interest rate cycle, we should be happy if we are able to keep it somewhere around 5%. Our broad level guidance is somewhere between 4.5 to 5, but we should be able to manage it closer to 5% in the rest of the year. Also, as the gold gets complemented with other products, whether it is in the wholesale side, SME will be a very important portfolio for us in terms of growth, and other retail products also start picking it up. Obviously, the margins will be a little lesser in those products, but that will also help our credit growth. And as I said before, margins is important, but more important is the growth in the balance sheet. So we'll focus on that as well. And we will not sacrifice growth for margins, but margins will keep it somewhere closer to 5%.
All right, Mr. Mondal, I know you said there are various, things are very dynamic out there. But in terms of a loan growth, 15 to 20%, will that be a gettable range?
Yeah. I mean, we should be happy to be there. Okay. And I don't rule out something higher than that as well.
Okay, good to hear that optimism. What about asset quality? Your gross NPAs, they're hovering around the 1.8 odd percent. Do you expect some worsening from here on, or will there be some improvement from here on? How do you see things panning out?
Yeah, that is little easier to predict. I think our asset quality will continue to be good. And as you know, that last quarter we had a negative credit cost. This quarter we had a marginal negative credit cost. So obviously credit cost cannot be negative for the rest of the year. But from a gross and net NPA, I think net NPA we're around 0.6. So I think we should be able to hold it around that level. And we don't see too much of slippages coming in. So, and as the balance sheet grows and the asset book grows, I think we should be able to manage the NPA ratio easily at the similar levels where we are today.
Some banks are also aggressively getting into the loan, gold loan portfolio. What is going to be your long-term strategy to counter that and make sure that you don't lose market share?
I'm not so worried on other banks getting into it. I'll tell you why. I mean, if you look at the larger banks, there are banks which has a 1 lakh crore book as well. And some of the larger private sector banks are also focusing on it. And I know the numbers. But for them, that business, and when you look at their overall business, it is minuscule. So the kind of focus which they have to give overall on their book and other businesses, our focus is very different. So if you execute our strategy right, I don't see a challenge at all because we have a very, very loyal base of customers. In the last 75%, 90% LTV scenario where a lot of people went for auctions and other stuff, we ensure that our customers remains loyal with us. We manage the NPA cycle. At the same time, we managed to hold the customers well with us because we didn't go for too much of an auction. So overall, I think we understand this business well. 42%, almost 42% of our asset book is gold today. And hence, if we execute it right, if you do our renewals right, if we get new customers right, I don't see that we need to be too worried about what other banks are doing. And generally, markets are also growing. And those banks will also start picking up some pie of that. So compared to the balance sheet size, I think our internal focus should help us in continuing to do well on gold loan. Having said that, I reiterate again that we don't want to be only a gold loan bank. We are working very hard. And within the next 18 to 24 months, you will see us almost all the retail products on our portfolio. And that requires a lot of investment into technology and completely shifting our entire tech stack, which we are doing. It takes around 15 to 18 months. After that, you will see a very different bank.
Final question, sir. You said you're not worried about other banks, but are you looking at any of those banks? Inorganic growth, is that something that CSB is looking at?
I mean, inorganic is always a possibility, but that is something above my pay grade, so I don't want to discuss that. It all depends on price and other issues, but not that I'm aware of anything which is getting discussed at this point of time.
We'll have to take your word for that then. Thanks so much, Mr. Mondal, for stopping by and filling us in with all those details. Wishing you a good year ahead, 15 to 20% growth at least, margins at around 5%, and optimistic that going ahead, it's not only going to be gold that fires, even the retail part of the book could be looking up. Well, time to slip in a short break, but on the other side, we'll be joined by another management. The management of Ramkrishna Forgings will be joining